Okay, we'll get started. Again, this is our developer webinar. It's hosted by ProLink Solutions, and we're going to be covering the latest trends in affordable housing finance today with Walker and Dunlop. Thank you guys for being here. And Tim is controlling the deck for us, which we appreciate. So we'll go ahead and introduce our team who's on the webinar today. Thank you, Tim. So beforehand, I'm Bree Kruder. I'm the Executive VP for ProLink, and I'm just moderating today's session. I'm joined by Tim Cotter, who's the Director of Capital Markets for Walker and Dunlop. Tim, do you want to introduce yourself?
Yeah, thanks, Bree. My name's Tim Cotter. I work out of Walker and Dunlop's Milwaukee office. I've been in the industry since 2007 with this company for just over 9 years. I sit on the capital markets team. So we're really the generalists of the organization, focused on financing all asset classes, multifamily, market rate and affordable, industrial, office, retail, and some hotels. We also work with a variety of lenders, agencies, life companies, banks, and credit unions. And we do perm loans, bridge loans, and construction loans. So rounding the experience out, somewhat of a niche, we also specialize in financing historic tax credit transactions around the country. So a little bit of everything, definitely never a dull moment.
Awesome, thank you. John Gilmer is the Senior Managing Director. John, you want to introduce?
Yes, very happy to be here. Thank you, Bree. Tim, John Gilmore, Senior Managing Director in our Affordable Housing Debt Production Group, focused primarily on Fannie and Freddie permanent loan executions in the affordable housing space. I sit in New York and work with a team of individuals that focus on affordable housing transactions across the country. Do a lot of partnering with Tim Cotter and Rob, who you're going to hear from in a little bit, as it always takes a village, I think, to get these transactions across the finish line. I know we're going to get into who we are in our firm a little bit later, so I'll just leave it at that and just thank you. Appreciate the opportunity, Bree.
Thank you. And then Rob Rotach is a Senior Managing Director as well. Rob?
Yes, thanks, Bree. I'm located out of our headquarters office in Bethesda, Maryland. I'm also in the affordable housing debt origination team with John, alongside John. My background is in underwriting. I transitioned into production. It's crazy to think, almost 8 years ago, into production from an underwriting background. I was a deputy chief underwriter in our HUD underwriting group for a number of years. Been in the business for 20 years now, and yeah, focus on primarily affordable. The more complicated transaction, the better. Affordable tax credit transactions, historic tax credits, low-income housing tax credits, and found my niche doing that, and enjoy the collaboration of the team here at Walker Dunlop.
Awesome, thank you guys so much. Okay, we'll move forward, Tim, thanks. So for today's agenda, I'm going to just have a brief introduction, make sure you guys understand who ProLink is and how we partnered with Walker and Dunlop. Walker and Dunlop will introduce themselves a little more. Then we'll get into the business study, which is emerging trends and solutions for the affordable housing development. And then I'm excited to see these case studies and transaction highlights that Walker and Dunlop has put together for us to look at and analyze together. And then any Q&A that comes up, we'll address that as well. So you see in the chat, you have a message from ProLink side, from the admin who's helping us out today, letting you know to post your questions. You can do it in chat or you can submit it to Q&A. Either way, we'll see it and we'll be monitoring it, and we'll make sure we address it by the end of this event. So thank you for that. Please submit the questions. We want to make sure that you get what you're looking for out of this event. Okay, so let's move forward. Quick introduction from me. So these, just so everyone understands this webinar series, ProLink Solutions provides technology in the affordable housing space. We started out supporting agencies, so housing finance agencies. We also support syndicators and investors in affordable. with portfolio management systems. And then we built Procorum, and Procorum is a collaboration portal that originally supported the agencies with managing their tax credit application cycles and their like asset management and compliance needs. So when tenant events are submitted to our agencies, the property managers and developers who are submitting those details are doing that through Procorum. Over the years, Procorum has expanded to offer a number of different tools and support to the industry. So we'll talk about that in a minute. And we've been supporting a webinar series for our agencies for a few years now. And recently spun up our developer set series. So we just had our first one last month. This is our second webinar that's really focused on the developer community. The point is to provide some industry knowledge and support, sharing of ideas, sharing of case studies and success stories to support this industry and provide more information and more connections amongst this community. So it will occur monthly on this same Wednesday, and it will last between 45 minutes to an hour per session. So thank you again to Walker and Dunlop for being part of our second chapter. We'll move forward to the next one. So for ProLink, we support 19 housing finance agencies in total. I guess 17 are housing finance agencies with LIHTC programs, and then 2 supportive services agencies as well that are located in California and New York State. So we are almost coast to coast here, you can see on that map, and looking forward to some more, supporting a few more in the coming years. And we'll go to the next slide here. So again, those are portfolio management tools that we're supporting those agencies with, managing all their whole affordable housing portfolio on our systems. And then again, Procorum is part of that suite of products. We're supporting over 1,000 developers on the platform, again, in that collaboration between developers and those agencies. And so it offers kind of a platform for collaboration. We've also built in some very specific industry specific tools like a tenant event portal where you're submitting those tenant events. And we're continuing to explore additional tools that are really purpose built. This is not kind of like a platform that is one size fits all for every industry. It's really built for the affordable housing industry. So since its origination, we've started to offer the Procorum Marketplace as well, which is a tool that allows Procorum, our team, to connect developers with gap financing and other financing sources that you may be looking for. So the goal is to really sort of bridge that gap and make it more attainable to do more affordable deals. We want to make this an easier process. It's very difficult to do affordable deals. As we all know, it can be complicated in good ways and bad. Sounds like Rob's very passionate about that. So the more complicated, the better, I think he said. So we feel that way too. We really enjoy this industry and the complexity it involves, but we do want to make sure that as many affordable housing projects as we can get through and developed, the better, right? So that's the goal with Procorum, and we look forward to working with you in the future. And with that, I'm going to pass it on to Tim to start the business presentation and introduce Walker and Dunlop.
Sounds good. Yeah, thanks, Bree, for that intro. I think quick comment on Procorum, ProLink, and the Procorum Marketplace. We've appreciated that partnership and over the last few years, and we have a handful of case studies to share later, which we can get into a little bit down the road. But first, I think a quick intro on W&D. We were founded in 1937. We are one of the largest capital providers in the market, particularly in the multifamily space. We're one of the largest agency lenders, but we also lend on industrial, office, retail, hospitality assets, and kind of special mixed use assets as well. So our product offerings are pretty wide ranging. As I mentioned, agency lending, debt brokerage, principal lending and investing. We also have an appraisal services platform in Apprise, housing market research and investment banking services in Zelman and Associates, and affordable housing capabilities, which I'll discuss in more detail later. Our mission is to create community with ideas and capital where people live, work, shop, and play. So with that as a baseline, I should just note, we also originate service for most of the loans that we originate, and we have a servicing portfolio of about 123 billion as of year end 2022. And last year we originated about 63 billion in transaction volume. So we're very active in the multifamily space and across the commercial real estate landscape. So getting into kind of more germane to this conversation is our commitment to affordable housing. So as part of our ESG objectives, we have a set goal to originate 60 billion of affordable and workforce housing over the next 5 years. So far, over the last 2 years, we've completed about 20 billion. So we're well on our way, but I think we still have our work cut out for us. Additionally, Alliant Capital joined the Walker and Dunlop team in 2021. So this added LIHTC syndication capabilities to our platform. Alliant has completed financing on over 1,100 tax credit properties with more than 100,000 units, and that served over 400,000 families. They were the 6th largest syndicator last year, according to NMHC. So in addition, I get kind of lastly rounding out this slide, we've added a dedicated affordable investment sales group. And this is an experienced team who's done almost 4 billion in transaction volume and 275 properties sold during their tenure. So this group is really helping clients invest in and divest out of affordable transactions as needed. So getting into, I think, just a quick kind of level set to discuss kind of the core of the problem. The affordable housing crisis, there's a national shortage of affordable rental housing. It's an ever-growing problem. It's really been ramping up since 2008. Recently, the NLIHC reported a shortfall of 7.3 million rental homes in their 2023 gap report. They put this report out every year. And this year, it showed the problem continued to grow over last year. There's just 33 homes for every 100 renter households with extremely low income. So pretty severe problem if you're in that demographic. In addition, supply constraints, in both the single family and the multifamily side continue to persist. And this is a function of higher labor or higher interest rates, labor shortages, some construction cost increases, which we've actually seen construction costs moderate throughout the industry a little bit, but that's been offset by increasing labor costs. So we're kind of running in place as it relates to construction costs overall. And then I guess compounding all of this is the bank failure crisis. We saw Silicon Valley, Signature Bank, First Republic, all those guys get taken over. And all of them happened to be buyers of GSE paper, and they were buyers of investors in LIHTC equity, either on a direct basis or as syndicators. So I think what this means is the general credit tightening across the industry with banks pulling back on construction lending, and there's downward pressure on credit pricing as there are fewer investors in the market and a little bit of additional uncertainty. So that's kind of the landscape we're in, but it's not necessarily all bad news. There are plenty of green shoots with, as I mentioned, Freddie, Fannie, and HUD. Agency capital providers are intended to be counter-cyclical. So we believe they will be a backstop to support the multifamily lending market for the remainder of the year. Next slide here. So now let me loop in John and Rob, who really live and work in this space every day, just to talk about what they're seeing in the market, along with some high-level discussion on kind of the core agency programs. So John, starting with you, staying nimble seems like the name of the game in today's market. How are you helping your clients approach transactions today? And what are you seeing in the agency space with LIHTC and non-LIHTC transactions?
Yeah, no, it's a great it's a great question, and I think you hit the nail on the head. You kind of identified the framework of what we're dealing with in the tax credit world, capital way affordable housing, and it's trying to round out a capital stack, right? Obviously, the 4%, 9% tax credit program has been one of the most efficient programs, public-private programs in the market since the program was created. That being said, it was heavily driven by a lot of CRA investors and bank providers that are looking for CRA credit, in addition to just wanting a proper risk-adjusted return. With all the volatility that's going on in the marketplace, right? With the bank failures that you talked about, we're seeing banks pull back, and I think Fannie Freddie especially is definitely to its benefit right now is a non-CRA mission-driven type of lender. They are a lender throughout any type of economic climate, regardless of where interest rates may be, regardless of where their tax liability may be. They are here as capital partners of Walker and Dunlop and capital providers to the market to provide a backstop of liquidity. And so, in essence, they operate through a couple of core products, and being nimble is, like you said, the real way to approach a tax credit deal in today's environment. It's not it's not in the old days, or let's say old days, 2 years ago, if that was if I can call that old days. With all the volatility, we have to really do a side-by-side comparison. And there is no one-size-fits-all approach to any particular transaction. The approach is trying to get to the dollars necessary in order to get to a closing at the end of the day. And I think through Fannie and Freddie's core product, which is a Freddie Mac tax-exempt loan and a Fannie Mae multifamily tax-exempt bond securitization, also known as the MTEB, those programs have been highly efficient in every state across the country, through pretty much every issuer across the country, and they are very programmatic in nature. The ways we're stretching in today's market is trying to figure out ways to really allow borrowers to enter into early rate locks through Freddie Mac's index lock feature, and allow for additional interest-only proceeds in transactions to allow for any type of deferred developer fees to be paid back quicker. We've also looked at really increasing amortization programmatically from 35 to 40 years. It's essentially not a like we spoke about earlier. It's not a one-size-fits-all approach. It's an approach to not bring a certain product to a deal, but let the deal dictate the product that we're offering. And I know we're going to talk a lot about other products, so I don't want to steal any type of shine from Rob, but I would love the audience to just leave with the fact that when we're looking at these deals and we're talking, and we'll talk about this a little bit later, but it's really somebody like myself, Tim, and Rob, across the table offering up, a capital market solution, going out to clear the market, a Fannie Freddie solution based on what the property should be able to support in that regard, in addition to other permanent loan products out there that Rob's going to talk about from the HUD side.
Yeah, so I'll just jump in from that, John. That's a nice lead into to the approach of how we like to do the side by side of the HUD, Fannie, and Freddie all together to kind of figure out which one is the best fit for that particular deal. And I think we cut out one of the slides from our original cut that we're number one Fannie Mae lender, we're the number two HUD lender, and we're the number four Freddie Mac lender. So you have nobody else has that type of relationships and depth of knowledge and transaction that we do. So we're able to see a lot of different transactions and kind of understand what might be the best fit for that particular deal and work with the developer to figure out what the approach is. I mean, it's always about proceeds, costs, and timing. And that's why it's not that every deal is kind of has different needs, and we can work with that developer to figure out which approach is. And then we bring in the experts to help execute, right? So it's our typical structure. I would come in on a HUD transaction, and John would come in on a Fannie or Freddie transaction, and Tim's out there finding the business, and building relationships. So that's the approach. On the HUD side, we've got two different primary products that we're our go-to for affordable transactions. The 221 D4 product, it's a new construction substantial rehab project. It's a 40-year AM automatically. It's not something we need a waiver for. Interest only during construction, fully amortizing. It's got you typically you can't beat the leverage. There are circumstances, in certain cases with tax abatements and such, where Fannie and Freddie can be very competitive on proceeds and costs. So it's really just that. That's why it's always beneficial to show the side by side to figure out, well, okay, what's the pluses and minuses of each transaction, and then detailing the time. Because on the time on these D4 transactions, you're typically looking at 6 to 12 months, depending on the particulars of where you are with your plans and specs, and how quickly you can pull everything together. But these tax credit deals take time, and they're complicated, as Bree said initially. And so maybe it's going to take that long anyway. I know everybody would love to close tomorrow on every transaction as quickly as possible, but that's why the D4 product can work well with a tax credit transaction, because it's the HUD process is going to take time, but the tax credit process and the building permit process, they're all going to take time as well. The 223F project program is another option. You can do upwards of 40,000 a unit in hard costs on those types of transactions. So it's not just a refi acquisition type project. You can actually do quite a bit of rehab as part of it. So it can kind of work well with a tax credit transaction that doesn't have a substantial amount of rehab to an existing project. There's also a vehicle for just doing takeout financing on construction. That doesn't really lend itself to tax credit transactions necessarily, because usually syndication groups or banks are requiring the debt on the outset in a construction loan to last through the construction. The tax credit compliance period, that 15-year compliance period. So you can't usually have a plan to refinance out as quickly. But it works really well for takeout financing for naturally affordable or workforce housing type properties, or even market rate, where you can refinance out of your construction loan fairly quickly, nimbly, and get into a very high leverage product at very competitive interest rates.
Got it. Yeah. Thanks, Rob. So I guess kind of my key takeaways from that are, John, you said you're not letting the product dictate the deal. Sounds like the agency lenders, at least they're very focused on mission-driven business, and which means basically affordability and green initiatives. So with that, any affordable transaction, kind of capital A or workforce housing, is really you're sort of agnostic as to where that deal executes. And I think with interest rate volatility, our position is if you have a deal that works, grab it and go and don't look back. So just a side note for the group, we can include specific term sheets that specify all the ins and outs of each of these products, and we'll send that out with the materials as a follow-up to the call. So then kind of moving from agency debt now to kind of more broadly looking at emerging concepts. Gap financing, that's kind of the name of the game with the decrease in equity pricing, continued rise in construction costs. Got to get creative in today's market to find solutions. So Rob, kind of staying with you on this, can you talk a little bit about what you're seeing across the country, how your clients are leveraging state tax credits and maybe some other legislation out there that's pending or recently been passed?
Yeah, absolutely. I love the format of this where you say all the bad stuff that's happening. I get to come in and say some good stuff. But yeah, state credits are really helping to fill a lot of the gap here. We're up to where it's half the states in the country now have state housing tax credit programs that are adopted that really help tack on and can work well with federal low-income housing tax credits. So you're seeing a lot of states that are investing, realize that there's a problem, and they're doing something about it, putting the money towards the programs and towards affordable housing, and it could all just be layered again on top of federal credits. And you're seeing states like Oregon, Louisiana, Mississippi, Alabama, and North Carolina are all it's all in legislation. So we're going to see even more investment from the states to kind of make sure that these projects can get built and they can get built where developers can actually make their deals pencil. And then we're seeing a lot of state investment even on top of state credits, where you've got examples of the Live Local Act that Governor DeSantis signed in March, where you've got where it provides substantial tax exemptions for affordable housing development, zoning variances, density variances, where you're seeing that the state take control of the situation to ensure that local governments can impose certain restrictions on the ability for affordable housing development to kind of transpire. And it's upwards of 711 million is what I've seen come out of this, that they're investing towards affordable housing as part of this. And it's not just towards affordable housing necessarily, it's also to meet that missing middle of workforce housing, that 80% AMI to 120% AMI. That's really been a challenge because there's always the housing tax credits are helping the 60% and below AMIs. But that 80 to 120% is a valuable, much needed housing stock in these communities that we're seeing. We're seeing a lot of development now actually makes sense because of the Live Local Act in Florida, where in particular we're seeing stuff in South Florida that's going to help on the workforce housing side for that deal to pencil.
Sure. Yeah, I would just comment here in my home state, we're actually seeing bipartisan legislation, and we're in a pretty polarized climate here, where lawmakers are agreeing that there's a problem and they're incentivizing affordable projects and sort of putting in measures to combat NIMBYism, and that's really an encouraging sign when you see groups working together that otherwise don't necessarily like each other. So some optimism there. Rob, what about ESG initiatives? What are you seeing in the market there?
Yeah, so the big example of this that came out last year was the Amazon Equity Fund. I mean, that's a $2 billion investment by Amazon in the markets that they primarily have. I think it's over 5,000 workers, which has been the Puget Sound area of Seattle, the Nashville market, and right here, Arlington, Virginia, DC Metro. So they're investing a significant amount of money into affordable housing development, workforce housing development, And we're seeing a lot of activity around. It hasn't really worked well with HUD because of some of their hard pay restrictions and requirements associated with their program, but we're seeing it work well. We're continuing to work with HUD, try to figure out if there's a way to blend those two programs, the Amazon Equity Fund and the HUD insurance programs. But Fannie and Freddie have kind of more or less figured it out. We're seeing activity around that. And these projects are getting done. And I could just see more and more of this type of ESG throughout the country, because again, Amazon is focused more or less on their primary markets. But I could see other companies adopt similar ESG models in their own markets, and you could see it help. These dollars would be critical to filling that need that Tim kind of highlighted at the beginning.
Yeah, I mean, I'll just jump in there. I mean, I would agree with that, Rob. I mean, we've seen, how successful that Amazon program has been. I mean, it's just other companies across the country that have this type of mandate, that have capital needs to deploy with a workforce in certain markets where, their workers are potentially being priced out, is something that folks are going to follow suit on, right? That the Amazon program has just been widely successful. So I couldn't agree with that I couldn't agree with that more.
Got it. Yeah, thanks, guys. So this is by no means an exhaustive list of all the gap financing opportunities out there. This is just kind of a flavor for what we could fit on one page. But John, wondering with all of these items, like call it AHP, HTF, Capital Magnet Fund, the Inflation Reduction Act. I mean, can you pair all these with agency debt generally?
Absolutely. I mean, Rob hit the nail on the head when he talked about the Amazon program, where Fannie and Freddie have been able to very quickly find flexible terms to allow for Amazon's hard pay structure. I think that I think the GSEs are going to be very, very flexible as they can be, as any senior lender can be in any situation. At the end of the day, a senior lender wants to be first mortgage secured, so that's super important. But it's also super important to make sure that the subsidy gets into these projects in a manner that's efficient and in a manner that allows the projects to close, in the most efficient manner.
Perfect. Okay, moving ahead here. Just in the interest of time, we won't go into detail on the items on this tab, but it's sort of a continuation of emerging trends. Quick note here, the Affordable Housing Credit and Improvement Act. This is another bipartisan proposal that's making its way through Congress that could provide some relief on the horizon. We'll watch that and hope that moves ahead. We're also, I'm guessing many people on the call, many in the development world, still sort of digesting HUD's 2023 income limits. We saw those come out last week, I believe, and trying to understand what that means for our developments that are in process and the ones in the planning stages. So I think let's charge ahead and jump into some case studies, which I think will be very interesting. So John, you want to kick us off with ABM?
Yeah, absolutely. It's my favorite part of the presentation, talking about case studies and the work that we've all collectively been able to accomplish. So ABM was actually a transaction that we worked in New York City directly with the New York City Housing Authority. And it was actually a RAD conversion. So it was three all public housing, 100% public housing properties located in Harlem, which were converted earlier this year which were transitioned to private ownership in partnership with the Housing Authority and the New York City Housing Development Corporation, whereby we were able to provide over $200,000 a door much needed rehab, like total retrofit of these buildings that had not been rehabbed in decades. And this was a transaction that we were able to close without a construction loan. We actually closed this directly with Freddie Mac. Freddie Mac closed on the transaction from day one, and we're funding the rehab escrow over time on an as-needed basis. The transaction was underwritten with a 40-year amortization. It had 5 years of interest only, which got the developers through the rehab period, and also offered in an additional 2 years of IO during on a post-rehab basis. We were able to come up with a capital stack that allowed for 80 to 90% Section 18 conversion and 10% RAD conversion. So we were able to kind of juice rents that way to allow for enough NOI for the property to be able to support this type of rehab. And it was really all done together with the residents. I mean, New York City has a pretty efficient RAD conversion program that's heavily centered around partnership with the community, partnership with the residents to let them know how their community is going to look, and to give them a say and a seat at the table in order to kind of decide which developer, which capital provider will be involved. And I think we're super happy for this type of execution getting done in this manner and without tax credits, right? This was also a transaction that was done as considered a non-LIHTC execution. I should take a step back. There were historic tax credits in the transaction. There were just no low-income housing tax credits in the transaction, but just a testament of how you're able to build a capital stack in that manner without using 4% or 9% credits, I think is a testament to all the folks that were involved in this deal. I know we're pressed for time. We got more we want to talk about, so I'll leave it at that in describing the NYCHA ABM deal.
That's huge. That's a big win for us as a team, and I know a lot of work went into that. Thanks for that, John. So moving ahead to Rob, you want to talk about Appleton and Spring Flats and Spring Flats?
Yeah, so this kind of had a lot of different things to it. So I thought it was a cool example. It's similar to John doing his deal in his backyard, which always means need a little bit more when it's right there, something you can drive by on your way to work if you want to kind of weave a little bit off the beaten path. This project's located right down the street from our headquarters office in Northwest Washington, D.C. here. You could see in the left picture, you could see the older building off to this. So this is a new construction to the left, which is the Spring Flats new construction, which is we actually financed through a Freddie Tell execution, versus the right side, which was a vacant historical building, has a really cool history, really cool looking building. I'm a geek for this sort of historical stuff. It was vacant, it wasn't used for anything, and it was transformed into 89 units of affordable seniors housing, or 88 units of affordable seniors housing. This was actually done in conjunction with 9% and 4% tax credits in what's called twinning. It's kind of been an innovative way for states to kind of get as much proceeds into projects as they can do. A lot of states are duplicating these types of models to get 4% and 9% into transactions to help these transactions pencil. So as a result, it had to have two different HUD loans, because you kind of bifurcate the 4% and the 9% funds between each of the different projects. But it ended up being a beautiful project for seniors housing in a good high rent area, typically in Northwest DC. So that was transact. And then on the adjacent parcel, you got the multifamily project, new construction, family asset with 4% transaction, tax credit transaction with a Freddie Tell. We did a Freddie Tell on this one. because they had some hard pay restrictions, a 20-year loan that had a balloon payment that didn't really work well with a HUD loan. So we looked at other vehicles, financing vehicles again, as a way to get this one done, and ended up being Freddie Tell is the best execution for that. So it's all about looking at the specific needs of each transaction and finding the best product that works for the developer in that project. So.
Awesome. Thanks, Rob. And then moving into our last case study, this is not in our backyard. This is a deal in Portland, one of 3 transactions that our team closed in the last 2 years. This was kind of interesting. This group reached out to the Procorum marketplace, and they were looking for credit equity and some help on gap financing. So the challenge here was it was generally the first transaction we worked on was a first-time Freddie Mac borrower with limited LIHTC experience. This particular deal, Minnesota Place, involved a broader development team with some folks that had more experience, but sort of that initial challenge was, number one, they were looking for credit equity. So we canvassed the market, identified PRIA ultimately to go forward as the credit syndicator here. So we talked to a number of syndicators, a number of potential LIHTC investors, and just really didn't have a lot of interest, just given it was a smaller transaction and a first-time sponsor. So there was some hesitation, which we're ultimately able to push through. So we're happy that CREA signed up and got on board for the first 2 transactions that we closed with this group. We also placed the construction and tax credit equity bridge with Stearns Bank, a group out of St. Cloud, Minnesota, that does quite a bit of LIHTC construction lending around the country. And then sort of rounding out the capital stack, we put in place a Freddie takeout, a 24-month forward. That's $11 million loan, which will fund upon construction completion. But right now, so that loan is committed and it's rate locked. I believe somewhere in the mid 5% range. We locked this in April of 2022. So they're under construction now. It was a 15-year loan term. I think we structured 24 months of interest only, and then there's a 35-year amortization after that. And sort of Freddie's underwriting parameters on this one, we were at about a 115 debt service coverage ratio and a somewhere around a 70% LTV. So again, this was a 2-year forward lock that was in the mid 5s, which looks relatively attractive today, and it takes a lot of uncertainty out of the equation, knowing that construction lender knows that there's a takeout in place upon stabilization and conversion. So it was a 72-unit deal in Northeast Portland, and we're looking forward to seeing them open hopefully later this year, potentially. So that does it for our case studies. So again, we'll send this out after the call, but feel free to contact us, and we can open it up to Q&A if there are any.
Awesome.
We're tracking well on time.
We're doing great. We hit it right on the money. It's 11:45 Mountain Time. I have Q&A open. If anybody has a last question, please submit it in the next couple of minutes and we'll try to address it here. Otherwise, we can follow up with the Q&A digest as part of the materials we send out. So thank you guys for being here as we wait to see if any questions come in. Tim, would you mind going to the next slide? I just thought I'd mention, as we're looking for any questions, I appreciate the case studies because they show different size deals, different products used. And while Walker and Dunlop is a large player, you do all kinds of deals with all different levels of tenure in the affordable space. And so I think that's something I want to make sure this group recognizes and hears after this webinar. If it is something that you're looking for right now, if you're starting to explore your financing options, please reach out to Tim Cotter. I think that would be a great resource for you. And I know through the Procore Marketplace, we've set deals and connected people, and sometimes it doesn't work out. They don't all, like, the match doesn't always happen within our network, but I do think that it has helped to provide more information to all parties involved in finding the right solution. So I encourage you to take advantage of this resource, and we look forward to supporting you in that effort. Let me see. I don't see any Q&A that's come in, so I think we'll wrap up at this point. But we will submit, we'll post and send out an email to all attendees with the recording from this event, with the slide deck and additional materials from Walker and Dunlop. And then please respond to that if you have any questions or would like connections from here. We appreciate your attendance and we look forward to hosting our next webinar. Thank you all very much for your attendance today and your participation as our panelists.
Thank you, Bree. We appreciate everyone's time today as well. And I would just say, yeah, don't hesitate to connect with us. We'll explore financing options on deals large and small. Regardless of your experience, we'll try to add value wherever possible. So thanks again.
Awesome. Okay, thank you. See you guys next time.
Thanks.